In May 2021, Goldman Sachs published a research report that dismissed cryptocurrency, and Ethereum specifically, as, quote, not an investable asset class. They called it excessively volatile, lacking fundamental value, and warned clients to stay away. Fast forward to today, and Goldman Sachs is actively trading Ethereum ETFs, offering crypto derivatives to institutional clients and building blockchain infrastructure services. So what changed? Did Goldman suddenly lose their minds, or did they completely miss one of the biggest financial revolutions of our time? Today, we're diving deep into how Goldman Sachs, the ultimate Wall Street establishment, went from calling Ethereum worthless to embracing it completely. This isn't just about one bank being wrong. This is the story of how traditional finance fundamentally misunderstood the future of money itself. Let's break it down. Let's start with what Goldman actually said. In their infamous May 2021 presentation, Goldman's investment strategy group laid out 5 key reasons why crypto wasn't a legitimate investment. First, they argued crypto showed excessive volatility, and honestly, they had a point. Ethereum had crashed from $1,400 to $80 in 2018, losing over 90% of its value. That's not exactly the stable store of value traditional investors expect. Second, they claimed crypto generated no cash flows or dividends. Unlike stocks or bonds, you couldn't value Ethereum using traditional financial metrics. No earnings reports, no dividend yields, no tangible assets backing it up. Third was regulatory uncertainty. Would governments ban crypto entirely? The regulatory landscape was a complete Wild West, with different countries taking wildly different approaches. Fourth, they hammered on energy consumption. Bitcoin mining was using as much electricity as entire countries, and Ethereum wasn't far behind. ESG investing was becoming mainstream, and crypto looked like an environmental nightmare. Finally, they argued there was no institutional infrastructure. No proper custody solutions, no regulatory framework, no way for serious institutions to safely hold or trade these assets. And Goldman wasn't alone. JP Morgan's CEO Jamie Dimon had called Bitcoin a fraud. Bank of America banned crypto trading for its clients. The entire traditional finance establishment saw crypto as a speculative bubble that would eventually pop. Looking back, their skepticism actually made sense. The 2017 crypto crash was still fresh in everyone's memory. Most crypto projects were vaporware. The technology was clunky, expensive, and seemed to only attract speculators and criminals. But while Goldman was writing research reports, something revolutionary was happening on Ethereum that they completely missed. While traditional finance was dismissing Ethereum, a parallel financial system was being built right under their noses. It was called DeFi, decentralized finance. In January 2020, there was roughly $1 billion locked in DeFi protocols. By May 2021, right when Goldman was calling crypto not investable, that number had exploded to over $80 billion. By the end of 2021, it peaked at nearly $180 billion. Protocols like Uniswap were processing billions in trading volume without a single traditional market maker. Compound was letting people lend and borrow money without banks. Aave was creating flash loans and a completely new financial primitive that couldn't exist in traditional finance. These weren't just experiments, real money was flowing through these protocols. Real yield, and then came NFTs. While critics focused on overpriced digital art, they missed the bigger picture. Ethereum was becoming the backbone of digital ownership itself. OpenSea hit $3.4 billion in monthly trading volume. Christie's sold a digital artwork for $69 million. Major brands like Nike, Adidas, and Coca-Cola launched NFT collections. Meanwhile, enterprise adoption was accelerating quietly. Microsoft integrated Ethereum into Azure. Central banks began piloting digital currencies using Ethereum-based infrastructure. But it wasn't just tech giants building on Ethereum. Companies like BDCS Inc., one of the first US publicly traded companies focused on blockchain infrastructure, launched Builder Plus, an innovative Ethereum block building operation that uses advanced algorithms to construct high-value blocks. They even partnered with Wharton's Mac Institute to research Ethereum's resilience and scalability, showing how seriously academic institutions were taking the network's development. So what did Goldman and traditional finance fundamentally misunderstand? 3 critical things. First, they completely miscalculated network effects. They looked at Ethereum like a stock or commodity, but Ethereum is infrastructure. Every developer who builds on Ethereum makes it more valuable for every other developer. Every DeFi protocol that launches creates composability with existing protocols. They call it money Legos, financial building blocks that can be combined in infinite ways. Traditional finance had never seen anything like this. It's like judging the internet in 1995 by whether websites generated dividends. Second, they missed the generational shift happening right under their noses. Millennials and Gen Z aren't just comfortable with digital assets, they prefer them. There's a $68 trillion wealth transfer happening over the next 25 years as baby boomers pass wealth to their children. And those children grew up with smartphones, digital payments, and programmable money. Third, they applied old metrics to a new paradigm. Price-to-earnings ratios and dividend yields don't make sense for protocols. The value comes from utility, network effects, and the ability to create entirely new financial products. While Goldman was looking for cash flows, Ethereum was creating cash flows for thousands of other applications. Here's the thing about innovation. Early adopters always look crazy until they look genius. While traditional institutions were analyzing and debating, crypto natives were building and capturing market share. By the time Goldman realized what was happening, they were playing catch-up in their own industry. The irony is that Goldman Sachs has built their reputation on identifying emerging trends and positioning their clients ahead of the curve. But with Ethereum, they became the trend followers instead of the trendsetters. So what's the lesson here for investors and institutions? Innovation often looks speculative until it becomes essential. Ethereum followed the same pattern. It looked like speculative technology until it became critical financial infrastructure. The institutional adoption wave is just getting started. We're seeing traditional banks integrate blockchain rails. Central banks explore digital currencies. Major corporations add crypto to their balance sheets. The line between traditional finance and decentralized finance is blurring rapidly. Looking forward, Ethereum is positioning itself as the foundation for Web3, a more open, programmable internet. Smart contracts are enabling new business models. Decentralized autonomous organizations are redefining corporate governance. The tokenization of real-world assets is just beginning. Goldman Sachs wasn't wrong to be skeptical. Due diligence and risk assessment are their job. But they were wrong about timing and inevitability. They treated Ethereum like a traditional investment when it was actually a technological revolution. The biggest risk wasn't investing in something volatile and uncertain. The biggest risk was missing the transformation of finance itself. So the next time a major institution calls an emerging technology not investable, maybe we should pay closer attention to what they might be missing. Because sometimes the most transformative innovations are the ones that don't fit into traditional boxes. What do you think? Was Goldman's initial skepticism justified, or did they completely miss the boat? Let me know in the comments below. And if you want more deep dives into how traditional finance is adapting to the crypto revolution, subscribe below for more blockchain analysis that cuts through the noise and gets to the facts. Like this video if you found value in the research, and explore all the sources in the description to verify everything yourself. Because in this space, doing your own research is everything. Thanks for watching, and I'll see you in the next one.